So in this video, we are going to talk about comprehensive financial plan. Like, a person may like to, buy a house or buy a car. So he make goal-based plan. Now, in this video, we are going to talk about comprehensive financial plan. A person would like to make a financial plan, till retirement, and after his retirement, he wants a regular income. So basically, a comprehensive financial plan is a plan which provides complete information on the overall financial position of the client and how financial goals will be met periodically. So let's talk about a comprehensive plan through an example here. So a financial plan of Colonel Rahul Gupta, and this plan was made on 3rd of November 2023. And let's have understand more about this guy, Colonel Rajesh Gupta. So he has dependent parents. His age is 38 currently, and he's going to take early retirement from the armed forces at the age of 48 years. He has an investment horizon of 10 years. So let's look at his current financial situation. He is having a monthly income of 2 lakh rupees, a monthly expense of 1 lakh, and he saves about 55,000 rupees per month. Currently, he has got 84 lakh 40,000 as his current investments. So that is what he has saved till now. And then he doesn't have a life cover, and his yearly income is 24 lakhs, and yearly expense is about 12 lakhs. So this is the information which he has given. So let's understand the financial requirements of Colonel Rahul Gupta, whose plan we are making. So he has a required return of 12.25%, which means that he would like to earn on his investment at the rate of 12.25%. And we'll discuss later what kind of investments he's going to make. And these investments will be made till his retirement. Now, the required rate of return after retirement has been considered as 8%. So after he retires, he would like to make 8% return on his investments. And we have assumed that the inflation would be around 6% in India. Now, his present age is 38 years, and he would be retiring at the age of 48. And he'll have an yearly savings of 6 lakh 60,000. Let's now summarize again what are the financial requirements of Colonel Rajesh Gupta, who is currently, having an age of 38 years, and is likely to retire at the age of 48 from the armed forces. So he's going to take an early retirement, and he would like to have a required return of 12.25% till the time he retires. So he can take risk because he's making earning. So he'd like to, have a higher return. Maybe that he's going to invest in equity and debt both. And we'll discuss those, instruments where he's going to, put his money. Then the required rate of return after the retirement, after he attains the age of 48 and he retires, he would like to, protect his wealth. So his required return, requirement goes down to 8%. And we have assumed in our calculation that the inflation rate is around 6%, and it will remain so for a long period. So we have discussed that his age is 38 and he's going to retire at the age of 40. Now he's making an yearly saving of 6 lakh 60,000. So in the previous slide, we discussed that he's going to save about, 50,000 rupees per month. 50,000 rupees per month for the 12 months. So his annual, saving will be, rather it was 55,000. So he's going to save 55,000 rupees per month, which means that he's going to have 6 lakh 60,000 rupees yearly saving. Now, we also discussed that, he has a present investment of 84 lakh 40,000 with him. So now we will move on to, his cash flow till the age of 60. So we are going to discuss, how he's going to generate, what kind of cash flow he'll have till the time of retirement, till the time he attains the age of 60. So the first column is the year, then the opening balance, how much money he has got at the beginning of the year, then what kind of a return he is going to get. So we have assumed 12.525% return till the age of 48 when he retires, and thereafter the return would be around 8% after his retirement. And the column G talks about his income, which is going to generate from the investment. Now we have kept it as interest income, but it may mean a capital appreciation or kind of dividends received from the mutual funds where he is going to. So entire income. So I can make instead of interest income, I can make it just an income. Okay, it will come from either dividend or capital appreciation or his redemptions of mutual funds. Then this is the yearly investment which he starts with 84 lakh 40,000. So he has this much of money with him, and then we talk about financial goals and the time of retirement, which is at the age of 48. So he's going to have retirement. So then we talk about the closing balance, how much money he's going to have. So these are basically the time, the column retirement. We have assumed what all expenses he's going to make, the monthly expenditure. So we are going to discuss that, the monthly expenditure after the age of 48 years. So, but before the age of retirement, so he's going to save some money, and rest of the money he's going to spend, so that money is not coming here. So before retirement, we have not assumed any expenses, so that has been inbuilt, because he's going to make some kind of a, he's going to get a salary, and he's going to save 55,000 rupees out of that, which is there. And for 12 months, so he's going to have a saving after meeting all his expenditure. So let's start. So at the age of 38, his initial money which he has got with him is 84 lakh 40,000, which he has put in various kinds of investments. So now those investments will be converted into the investments which will yield him 12.25% returns. So his closing balance at the age of 38 is 84 lakh 40,000. Now we come to the age of 39. So he starts with his opening balance, which is nothing but the closing balance of the last year. So he's going to have 12.25% income on that, which will be 10 lakh 33,900. And then apart from this income, he is going to save 55,000 rupees per month, which will be 6 lakh 60,000, which has been given here. So then his closing balance will be at the age of 39 when he completes he'll have a balance of 1 crore 1 lakh 33,900. So we can just look at the formula here, which is nothing but the sum of the opening balance plus the income and the investments. Then he starts with the opening balance at the age of 41. So he has got 1 lakh 20,000. Okay, so I think we have missed out this. So he starts with 1 crore 1 lakh 33,900, and he earns 12.25, which is 12 lakh 41 this thing. So that is the money he's earning on his opening balance, and similarly the income which is earned in the first year, we can see he's earning 12.25% on 84 lakh 40,000. So which means he's this balance is going to go up, and similarly at the age of 41 we'll start with 1 crore 20 lakhs, which is the closing balance of the last year. Then he's going to make another 12.25% return. So just to check that, so the formula is the opening balance into 12.25% return. So this way he's going to save another 6 lakh 60,000 during the year out of his regular income, and his balance will go up to 1 crore 41 lakhs. So he'll keep putting this money every year, and it will generate 12.25%, and his investments, he's going to make further investments of 6 lakh 60,000. So his balance is going to go up. Now when he attains the age of 48, he retires. Okay, then at the age of 49 he starts with a balance of 3 crore 85 lakh, which is coming from the closing balance at the age of 48. So he starts with 49 at 3 crore 85 lakhs, on which he is going to earn 8%. So we can check this, which is 8% of 3 crore 85 lakh 27,000. Okay, so then he is not going to have any income because he is retired from the armed forces. So his expenditure we have considered here, which is his yearly expenditure. How we have calculated? Now when we are discussing his case, he's spending 1 lakh rupees per month. So which means for 12 months it will be 12 lakhs. So then we have calculated that his total expenditure after the retirement would be 22 lakhs 77,958 yearly. So we have assumed, the inflation of 6% for 11 years. So we calculated the future value. So we can just, do the calculation again here. So we put the formulas and go to, FV, rather go to this formula and put the rate of interest at 6%. Okay. And NPR is, is after 11 years. And the present value of the amount is 12 lakhs. So we'll put a minus sign here. So which means that his annual expenditure would go up to 22 lakhs 77,000. So this is the amount which is coming here. So which is equivalent of 12 lakhs after 11 years at the rate of 6% inflation. So that means his yearly expenditure will be 22 lakhs 77,000. So that means his total amount, he starts with an opening balance of 3 crore 85 lakhs on which he earns 8%. So that means he has earned 30 lakhs 82,198, and out of that he's not making any income now, and he's going to spend 22 lakhs 77,958 rupees for his household expenses. So which means his closing balance will be 3 crore 93 lakhs. So similarly, so he has at the age of 50, he has an opening balance of 3 crore 93 lakhs on which he earns 8%, and which amounts to 31 lakhs. So we can check this formula again. So it is right. So 31 lakh 46,000, and now his annual expenditure will go up by 6% more. His annual expenditure will be 24 lakhs 14,000. So if you look at this column, his annual expenditure is going up by 6% every year because of the inflation. So expenses will be income more every year. So which means, if we use this calculation for the age of 49 till 60, he's going to earn 8% on his total investment, balance of investments after meeting his expenses, household expenses, which is written in the column J. And so that means he will have 3 crore 93 lakhs 89,404 rupees at the age of 60. So this is the total amount of corpus he will be having when he attains the age of 60. Now we come to, so he has got, the scenario, his financial scenario at the age of 60 would be that he will have no monthly income. His monthly expenditure will be there definitely. So his initial investments will be 3 crore 93 lakhs. So he's going to, have a corpus of 3 crore 93 lakhs. So we'll start with this. And his yearly expense will be 21 lakhs 62,120. So how we have got? Basically, we can just go back to it. So it is T24. So when we look at T24, so this is his yearly expenditure, which is, when we discussed the case with him, he said his expenditure will go down by half. So, this is this expenditure in the year at the age of 60 when he was, spending 43 lakhs. So after his retirement, he is going to manage his, household expenditure by just half, because by the time he is retired and his children will be, grown up, and he will not have any further expenditure. So his expenditure is going to reduce to 21 lakhs 62,000. So we remove this. So we come to, this column again. So here, this is his yearly expense. And now his required rate of return is 8%. The inflation we have assumed 6%. His age is 60, and the age of now we have age of retirement, will be 60 years. So what we have done is that we have assumed now till the age of 80 how the investments and his return will look like. So the first year is year. We talk about all the years. Suppose he lives up to the age of 80, we have assumed. So this is his opening balance, how much money he has got, 3 crore 93 lakhs to start with. At the age of 60, he had got 3 crore 93 lakhs. So we have assumed this 3 crore 93 lakhs as his opening balance, and then the expenditure at the time of retirement, which is half of the expenditure which he was incurring till the age of 60, and this will be his closing balance. So here we have taken the opening balance, which is coming here from this opening balance, which is the column J. So we have taken it here. This is, money he's going to earn at 8%. So that, which means he starts the year 61 with 3 crore 93 lakhs with him. Okay. Then he earns, 8% on this. So if you check the formula, it is 8% here. Okay. So on 3 crore 93 lakhs, he earns 8%, which is 31 lakh 51,000. And, spends about 22 lakhs 91,000. Again, this has been the opening, the expenditure at the age of 60, which, we took it from here, which is, I'll again show you, which is, the expenditure, which is just the half of the age of 60 when he was, aging 60. So he was spending 43 lakhs and now he's going to spend 22 lakhs 62,122. So if you can just check this here, somewhere we have mentioned, what will be his, expenditure. So his, yearly expenditure. So financial requirements. Okay, so I think he had mentioned it to us that his expenditure will go down to half. So that's why we have taken it half. So we go to back to the, the table here. Fine. So he earns, okay. So this was, his, when he attains the age of 61, then 62, 63, likewise, we have considered 8% return on his, balance what he has got after meeting his personal expenditure, which is growing by 6% because of the inflation. So at the time when he retires, and achieves the age of 80, which means he'll have, opening balance of 2 crore 21 lakhs still with him. And with 17 lakhs 72,000 is his income, 8%. But his expenditure will be 69 lakhs 34,000 in the exit year. So we'll have, closing balance of 1 crore 69 lakhs. So we can just, hide this column because this is appearing twice. So to start with again, so at the age of 60, he had amount of 3 crore 93 lakhs 89,404 with him. So which we have taken it from here, 3 crore 93 lakhs 89,000. And then, so this will be his, and he's going to spend, 21 lakhs 62,122 rupees for meeting his household expenses. So I can write this as household expenses. So which we have assumed that they will go down to half of what he was spending till the age of 60. So which we have collected from here. So this is 21 lakh 62,122, which is just the half of this amount which he was spending earlier. So let's go here. So his household expenses are this much. So that is closing balance. So he starts with the opening balance of now 4 crore 2 lakhs, on which he earns 8%. Okay. And we can check the formula again. So he's earning 8% on that. So his amount will go to 4 crore after spending 24 lakhs 29,360 for his household expenses. Amount closing balance will go to 4 crore 10 lakhs. So this way, he's going to have his income and expenditure. This will be his income by way of 8%. Mostly it will be interest income and little bit of equity. So which means is that age of 80, he'll still have opening balance of 2 crore 21 lakhs. He's going to earn 8% interest on that, and he's going to spend his expenditure will go up by 6% per annum because of the inflation. So he's going to spend 69 lakhs 34,000. So that means he will have 1 crore 69 lakh with him. So what we have done is that we have considered his how much he's going to invest portfolio till retirement, that is the age of 48, and then this is the suggested portfolio till retirement, and then suggested portfolio after the retirement, which is going to give him a return of 8.5%, and the portfolio till retirement, it is going to give him a return of 14.28%, but we have considered only 12.25 return for our calculations to be very conservative. So the first column talks about the funds where he's going to invest his money, And what is the CAGR? That is the compounded annual growth rate, which the fund is presently generating. And then the weightage of investment, how much money he's going to invest in each scheme. Like, this fund is going to, he's going to invest 30%. So this is the weighted average return which he's going to get. And then the risk which he's assuming by investing in these funds. So it is measured in standard deviation, and this is the average risk, the portfolio risk. Okay, so this is the portfolio risk. So let's talk about the first. He's going to put the money, some money in Nippon Large Cap Fund, which is a fund which is giving a very good return. Currently, it is giving a return of close to about 13% over a long time period, and he's going to put 30% of his money in Nippon Large Cap. So the weighted average return will be 3.9%, because since he's going to put 30%, so the return is going to get 3.9% on his portfolio. The risk will be 20.64. The average risk will be 6.39, which I have calculated, like this. If you take the formula, so it is basically 30% of the risk, okay, the total risk which is having, and the weighted average return is again calculated by taking 30% of 13% which this fund is giving. So similarly, the second fund is going to choose the second fund which is going to choose is SDFC Mid Cap, which is little riskier fund, which is giving 18% return over a long-term period, and the weightage will be only 5%. So the weighted average return which he is going to get, a portfolio weighted average return. So I can just make it this as portfolio weighted average return. Okay, so sorry, this I can just change and make it portfolio. So let's come back to this. So SDFC mid cap 18%, 5% will be portfolio weightage. So he's going to get 0.9% with the standard deviation risk of 20.88 and with the average risk of 0.104. Then he's going to put another 5% in Nippon small cap, which is giving a return of 20%, but it is more riskier. And his weighted return for the portfolio will be only 1% from this fund, and the risk will be 23% because the fund is more riskier, so it has a higher risk, 23.46. So this average risk is 1.17. Then we come to, he's going to invest some money in gold and silver by investing in a fund, promoted by Edelweiss, which is currently giving 10% return. Weight will be 15%, which is, 1.5% the weighted return. So risk is here less, which is 13.87. Okay, then he's going to put some money indirectly in equity, which is going to be 20%. So the weight will be 30% of the money will be put into stocks, and which will give a 6% return on his portfolio, weighted average. And the standard deviation risk is 10%. The average risk is 3. So then he's going to put some money in Kotak. He's going to put Kotak Arbitrage Fund. So this is basically a fund which is risk-free almost. So he's, 15% money will be put here. Now this is basically to take care of some emergency requirement. 3,60,000 will be invested in Kotak Arbitrage, which is giving 6.5% for any emergency requirement of the Rajesh Gupta, Colonel Rajesh Gupta, who is going to, invest there. So Kotak Arbitrage Fund, which is, weightage will be 15%, and the return will be 1%. So overall return will be 14.28% for the portfolio, and the risk, the standard deviation risk, which he's going to assume is 13.64. So this is going to be the risk he's going to take. If he put all his money into Nifty stocks or equity market, the risk is 18.5%, and the return of Nifty is close to about 12.57%. So here what we are trying to say is that, by putting the money directly into equity, stocks, all good stocks, which give a return of, only 12.5% with risk of 18.5% here. The risk is 13.64, whereas he's getting a return of 14.28%. So this is more, a better way of putting your money. The risk gets reduced and your return goes up. Then, we're talking about, we are going to put money into, generate after his retirement, So this is after when he attains the age of 60. So he's going to put some money into ICICI Prudential Gilt Fund. These are G-Secs, basically the government bonds, which is giving 7.5% CAGR. So he's going to put 50% of money there and 50% of the money in SDSC Hybrid Debt Fund, which is basically some equity and some debt, which is a conservative fund, which is giving 9.5% return. 50% will be here. So the weighted average return he is going to get is only now is going to get is 8.5%. But we have assumed only 8% return to be very conservative while calculating, his cash flows. Then the risk is very less, which is 4.4% as compared to equity, which is was slightly higher, which was around 13.64. So with this amount of risk, he earns close to about 8.5%. So this is what he is going to invest.